Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Let's take a look at some of the top stories we are following in the BNN Bloomberg newsroom. Prime Minister Mark Carney has agreed to intensify free trade talks with the South American trade bloc Mercosur. Carney met with Brazil's president during the G20 summit in South Africa. Ottawa claims bilateral trade with Mercosur is a significant opportunity for Canada in sectors like industrial goods, chemicals, forestry, and seafood. Mercosur has a combined GDP of more than $4 trillion. Industry Minister Melanie Joly is heading to South Korea today to meet with major Asian companies to attract large investments into Canada's defense sectors. The meetings will include talks with one of two bidders on Canada's major procurement project. Joly is also meeting with a Korean business conglomerate and heading to Tokyo afterward. Their talks will cover the automotive industry, battery manufacturing, shipbuilding, and mining. Shares of Novo Nordisk are dipping in the pre-market. Take a look down now, more than 10% right now. This after the pill version of its weight loss drug, Ozempic, failed to slow Alzheimer's in patients in a pair of large studies. The company says trials to use the drug for Alzheimer's was a long shot anyway, as it struggles to regain its footing in the obesity market after losing its top spot to Eli Lilly. And taking a look at the markets now, the U.S. futures heading into the Thanksgiving shortened week. They are up. Dow 0.23, NASDAQ 100.83, and the S&P 500.54%. All of them in the green. Optimism over a Fed rate cut driving that. Investors may be trying to take back some of the losses. November's not been kind so far. Moving over to the TSX, looking to continue its rally from Friday that saw it cut the weekly loss at a little more than a half a percentage point. It was up on Friday, 254 points, 0.85%. The materials sector led by gold mining stocks getting most of the credit for that. And as we move over to oil, it's dropping again. It's continuing that downward trend after sitting above 60 for a little bit. Geopolitical tensions, easing of them, including optimism about a peace deal between Ukraine and Russia, along with expected increases in production by OPEC Plus, pushing oil down right now, but it's up ever so slightly for the morning. Taking a look at gold, down slightly. Traders weigh possibilities of that Fed rate cut. It is off by 0.04%, almost a wash, $1.70. When you look at it, still above 4,100. Our loonie, softer still on that Canadian economic data. It continues to put that downward pressure on the Canadian dollar. It's off by 0.01% right now. And Bitcoin's had a bit of a ride lately. It's bounced back slightly, but now it's down again, about 2.36%. And it lost probably close to 10% in the past week with that downward pressure. As we were just talking about, U.S. markets look to open in positive territory this morning. There are signs the Fed has room to cut rates further, and fears of a bubble appear to have taken a back seat, especially with AI. Let's get more on this from Brad Bernstein, Managing Director at UBS Private Wealth Management. Brad, thanks as always for joining us.
To be here today.
Optimism for a bull market. Where do you start with that?
So, despite recent volatility, we maintain the view that the bull market is absolutely still intact. We see 7,300 by June and potentially 7,700 by the end of the year, driven by three things. One, yes, more Fed rate cuts. Two, continued strong earnings and the AI growth story.
Let's start with the Fed rate cuts. It's gone back up,
Sure.
I think, about 70%, the odds right now for a cut coming up over the next little while. How many do you see, and how many would you like to see?
So we see right now 2 by the end of the first quarter. So there's 3 Fed meetings coming up between now and March 31st. We see at least 2. I think the volatility that we saw, that incredible reversal on Thursday, when markets had a great morning, and then around 10:30, we saw them just fall apart and have a real ugly close on Thursday, was probably caused by the U.S. government's announcement that the November job data would be delayed about a week post the December 10th Fed meeting. And then we walked in Friday morning, 8 a.m., and we saw the Fed, John Williams, vice chair, very influential, put out very dovish comments. That turned markets around on Friday. And we went from about a 30-ish% chance of a cut Thursday morning to today. It's actually about 77%.
And so a reason for optimism. And what happens, though, if we only get, say, one cut? What kind of a play is that?
I think markets, what we've seen over the last few weeks, the volatility that we've seen has really been caused by the uncertainty post the last Fed meeting with the hawkish cut that we got. So I think for markets to have a smooth ride, we need to have more continued, understanding of Fed policy and rate cuts. I don't think, clearly if we don't get a rate cut on December 10th, I do think that would be a cause for some more volatility that like we've seen recently.
All right, and of course, the other big thing that's driving everything right now, AI, NVIDIA, we saw their earnings last week. They were good. They were better than expected. We still saw a negative reaction to it. Today, though, we're hearing that they may be able to start moving more chips to China. How important is that just for NVIDIA and for the AI itself?
Well, I think there's no doubt that what we're seeing is major increase in CapEx spending in AI next year. But what's more exciting for us is the clear evidence of monetization happening. Look no further than enterprise software, computer-facing applications that are generating revenue, as well as many leading cloud platforms have reported increasing revenue. So it's not just about the spend. We're really, we think the critical next phase of AI growth is the actual cash flow positive story that's starting to happen.
And how important is that you're seeing it across the group, not just NVIDIA, not just in one company?
Well, I think it's critical. I think it's critical for the rally to continue. It's important. Part of the volatility perhaps has also been the concerns around the continued growth and not just the spending, but the actual profitability and cash flow generation, as I just mentioned. So I think it's critical for the rally to continue, that next phase does develop and continue to develop.
And is there room for all of them to succeed here, do you think?
Well, I think it's impossible for every company, in the AI space or in any space to be incredibly successful. There will certainly be winners and losers, but the overall story remains strong. The spending is undoubtedly increasing, as well as I just mentioned, the positive cash flow and actual profits and monetization starting to happen.
And what about the rest of the market to you? I mean, there's so much talk about AI, but what about the rest of the market, and what is it doing, and what opportunities do you see there?
So one of the positive stories that we just saw as we come to an end here in quarterly earnings season for the third quarter is that it's not just big tech that's having the growth. The median earnings growth rate in the S&P was over 5%, which is higher than normal. We saw earnings this year up about 11%, and now we're projecting overall earnings to be up about 10% next year. So earnings growth is across the board now, which is extremely encouraging going into the next year.
And just taking a bigger picture going overseas, you were looking at Japan, and that's caught your attention.
Yeah, well, we actually also just increased our estimates on Europe for next year. We just upgraded Europe to attractive. One of the big catalysts in Europe is Germany, who will be spending about 20% of their GDP on infrastructure and defense spending. So that's actually a big catalyst in Europe, and we think Europe looks really good going into 26. It had a great 25, but we think it'll continue next year. And
Japan as well, the spending plan there, your thoughts on that?
Yeah, absolutely. And I think what they're doing right now with their Fed policy also has a big impact on global markets right now. So Japan's very important, and we do like Japanese markets.
And how do you see, what kind of an impact do you see that having on the world markets?
Well, I think I think what markets like to look at is the yen to the dollar, right? And what they're doing with interest rates. And it has a huge impact on risk taking. There used to be the yen carry trade that's always had some, material impact on global markets. But outside of internally in the US, we also like financials, healthcare, and utilities as well in the US.
Okay, on that note, we'll leave it there. Brad, thanks as always for joining us.
Thank you.
Brad Bernstein is the managing director at UBS Private Wealth Management. Coming up, we'll update you on some of the opportunities ahead for increased trade with some of Canada's G20 peers. Well, Prime Minister Carney is in Johannesburg, South Africa, where he sees the opportunity to secure investment in Canada at the G20 summit. CTV's Rachel Aiello has more.
Good morning.
Prime Minister Mark Carney wrapped up his latest foreign trip today, taking big steps towards trading more with India.
Does your government view India as a reliable trading partner?
In terms of trade, yes, we do, actually. You can be both a reliable trading partner and there will be some sources of friction.
After saying that, Carney sat down with Indian Prime Minister Narendra Modi, their second one-on-one meeting in the last 6 months. And the two emerged announcing Canada and India are launching negotiations towards a new economic partnership agreement.
The ability to have more effective trade with them, to scale that trade with them, would be greatly helped by that.
This reset comes after years of strained relations over allegations India denies of involvement in criminal activity on Canadian soil.
With respect to any forms of foreign interference, we have to remain vigilant. We are vigilant.
Carney also announced today that after talking on the sidelines of the G20 summit, he and South African President Cyril Ramaphosa agreed to launch talks towards a new bilateral investment agreement. Since taking office, the Prime Minister has secured nearly a dozen new economic and security partnerships in a push to diversify away from the United States. And as he pursues more deals, Carney said Canadians shouldn't consider that engagement as an endorsement of everything a country does.
There are countries that we're not doing business with, that we're not talking to.
Asked today when he last spoke to U.S. President Donald Trump, Carney dismissed the question. The Prime Minister said he's been busy, and when the Americans want to resume trade talks, Canada's ready.
That was CTV's Rachel Aiello. The United Arab Emirates has committed to investing $70 billion in Canada. The investment will be in vital sectors, including energy, artificial intelligence, logistics, and mining. The announcement comes on the heels of Prime Minister Carney's visit to Abu Dhabi. We got more on this from John Manley, former finance minister and senior advisor at Bennett Jones, and also a chair at Jefferies Canada.
I was just in the UAE in September in my Jefferies role, and we were visiting with a lot of the major investment firms, the sovereign wealth firms in the UAE. Mm-hmm. We did a deal, as you may know, at Jefferies. We acted for Mubadala, which is one of the big sovereign wealth firms, in their take private transaction of CI Financial, which was over roughly a $5 billion deal. And so there's more where that came from, I'd say. And oh, by the way, I'd say that one of the things that I picked up in the course of my visit there was that Mark Carney personally was very well known in the UAE because he had been there frequently in his Brookfield role. And so he left a lot of footprints and was very well thought of by the investment community in the UAE.
It's sort of a complex place to do business with, John, isn't it? Because the New Yorker just had a piece about Daniel Kinahan, who's a major Irish drug dealer. He heads up a $1 billion coke empire, and he has found sanctuary in the UAE, along with some other drug dealers. Now, apparently the UAE is trying to kick them out, but these fellows were allowed just live there as long as they didn't commit crimes in the Emirates. So it's a very different kind of society and government there.
Well, there's no doubt about that. It's not a democracy, but truthfully, we know that how reliant Canada and its economy are on trade and inbound investment. And if we're only going to do business with like-minded countries, democracies with liberal values, we're not going to be doing business with very many players in the world. So we have to balance our interests and our values in order to make sure that that we continue to build the kind of prosperity that enables our people to have the life that they want to have and continue to support our values.
I mean, you're so right. We can't always do business with Western democracies. Yeah. I'd love to get your take as a former finance minister. You know a bit about financing arms spending. What do you think? It'd be hard to draw you on this, but do you think Mr. Carney will go with some Swedish fighter jets as well as the F-35?
I think it's going to be a tough call because the advice that he will receive, having been around the table when we've done these big procurements, is that it's not usually a good idea to have different kinds of equipment. That, you know, it's more complicated from a training point of view. It's more complicated from a maintenance point of view, and there are obviously going to be capability differences between the F-35 and the Saab aircraft that are, you know, may dictate what's available for particular missions. So he's going to get a lot of pushback on it. On the other hand, we know that we're trying to build an alternate economy here to the one that we've relied upon for 40 years. It's going to require us to do some things that that kind of break the mold a little bit. And, you know, would that we had continued to produce the Avro Arrow in the 1950s, we might have been the ones that were offering these contracts to others, but we didn't. And now we've got to rebuild. So I'd say this is going to be one of the tough calls for his government to make, and it's a lot of money, Andrew.
Yeah, it is a tough one, and obviously the Americans would be irate if we were to cut back on the F-35 purchases. You've been around a lot of government blueprints and plans as well. Did anything jump out for you with the announcement of those infrastructure projects that the government is leaning towards favouring? I don't know if they've fully been adopted by the Major Projects Office.
Well, I think that, first of all, I think it's a good sign that the government's actually talking about promoting getting things done. I mean, one of our problems over the last number of years is an inability to get things done. And so I think this is a really positive signal. I think it's also important to remember, and I don't think a lot of listeners to the budget paid attention to this, but the investments that are government-driven and the so-called capital account deficit is all based upon matching or more funding from the private sector. So what they're trying to do is, we could put it this way, is to crowd in private sector investment. That's a very important and powerful thing. But the big thing to me is, let's get some things done. Let's put some check marks on the board and show that we're not going to bog ourselves down in regulatory red tape. We're actually going to build things that are important and that last.
And he was speaking to John Manley, former finance minister, former deputy prime minister, senior advisor at Bennett Jones, and chair at Jefferies Canada. Up next, shares of BHP are down slightly after it confirmed it is walking away from Anglo American and bringing Anglo American's takeover of Canada's tech resources one step closer to reality. BHP has walked away from a fresh takeover attempt of Anglo American. For more on it, we are joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks as always for joining us. Second time, not the charm.
Exactly. So this is the second time BHP has tried to do a takeover like this with Anglo American. We've got a lot of different copper mining companies all kind of merging together here, or maybe trying to. But this time around, BHP said they did hold preliminary discussions with Anglo American over the weekend. And now, after those preliminary discussions, sources are reporting that it says it will no longer focus on a takeover of Anglo American. It will instead focus on a combination and will focus on its own portfolio instead. And again, this is the world's largest mining company we're talking about here, BHP. It's an Australian mining company, very much focused on copper within the future. And it was seen as a short-lived attempt to take over Anglo America, and also this short-lived attempt to kind of thwart this planned merge that Anglo America and Teck Resources have right now. Teck Resources, of course, being a Vancouver-based company. So, as you mentioned, BHP, they did make a similar attempt last year. Bloomberg had been reporting that they made that similar bid in recent days. It was a mixture of cash and stock this time around, and Anglo America rejected that. That's according to sources. But this, renewed attempt obviously shows the pressures that these companies are feeling right now, particularly within the copper industry. Supply has been dwindling, but we know demand is expected to pick up, particularly as AI picks up as well.
Data centers.
Exactly.
Right?
And you need copper for all those data centers. It's a better way to kind of funnel that electricity through wires and through other things like that. So a BHP takeover of Anglo America would have resulted in a dominant copper producer. But of course, they would have run into regulatory issues had they gone down this road. Some companies in the past, some countries, I should say, China, Europe, last year when this was in the news, were not happy with the idea of such a big takeover. So either way, they would have run into some regulatory issues.
It didn't sound like a wholehearted attempt. And the vote's coming up for Anglo and Tango. Anglo and Tango. Anglo and Teck.
Yeah.
When's that? What's going to happen?
That is happening on December 9th. So yeah, it's just weeks away at this point. Shareholders from both Anglo and Teck are expected to vote on this. This deal would create a company worth more than $60 billion. It is, of course, a plan that would still need to be approved by Ottawa. But again, this is happening on December 9th. Analysts are predicting the merger will go ahead. Shareholders will at least vote in favor of this. But we know Industry Minister Melanie Joly not entirely happy with this so far. She says right now the pledges by Anglo are insufficient. They want to see more jobs in Canada. So we'll have to wait and see what happens with this merger. But Anglo and Teck estimate they can save $1.4 billion US annually by merging together. Both of the company's two largest mines are in Chile, about 15 kilometers away from each other. Okay. So obviously the idea here is to merge those two together and really get started on hopefully potentially producing more copper.
Okay. Lindsay, thank you for that.
Thank you.
BNN Bloomberg's Lindsay Biscaya. Let's take a look at the U.S. futures as we count down to the opening bells. And looks like it's going to be a better day. We can see Dow's up 0.21 in the futures, 0.92 for the NASDAQ 100, and the S&P 500 up by 0.59. And taking a look at gold, it's sitting almost at a wash right now. It's 0.15% down slightly, but still above that $4,100 mark as everybody awaits the news of a possible Fed rate cut coming up. The odds of that happening have increased to about 77%. And oil as well, off slightly on the likelihood of an end to the Russia-Ukraine war. The opening bells are coming up next. Time now for the opening bells for this short week down south of the border. At the NASDAQ, Verit Assessment Management is ringing the opening bell right now. And at the New York Stock Exchange, it's Exeo Group. You can hear the ringing there. And Canada Climate Week Exchange 2025 is at the TSX. Time now for the first 15. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity markets, and they are trading up as was expected. You can see the NASDAQ off to the races, up by 0.98%. TSX coming off that Good Friday up as well, 0.12%, and the S&P 500 jumping as well, up by 0.61%. And so let's take a look and see the big one, of course, I think that we're talking about right now. Teck Resources, on the news of the sale that was talked about, and it's not going to happen now that we were going to see a possible takeover or possible offer for Anglo American, which is looking to buy Teck by BHP. That was rejected. So now it looks like the Anglo American possibility of taking over Teck Resources is still in play. There's still some pressure politically up here, of course, but right now you can see Teck is off by 0.36%. And for movers south of the border, we're joined now by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team on Stocks. And Jeff, thanks as always for joining us.
My pleasure. Thanks for having me.
Okay, some good news for some health groups. I don't know if we've been saying much of that lately, have we?
Then we have not seen much of that. They've been in desperate need of good news, and they're finally getting it this morning. So Politico reported over the weekend that apparently the White House is in talks and is open to the idea of keeping the Affordable Care Act alive. This is sometimes referred to as Obamacare, and the expectation was that with the budget deliberations, with the U.S. government shutdown, that this was going to be something that would just expire, and some of these companies would be under a lot of pressure. We are seeing the exact opposite this morning. So Centene, Oscar Health, Molina are all three stocks to watch today. Centene was the top performing stock in the U.S. In the S&P 500 pre-market. Oscar Health was up 20% pre-market. For a health insurance company to rise 20% is just, I mean, unheard of. You buy insurance companies because they're stable, they pay, they grow a little bit over time. 20%. That's a huge move. Also worth watching Molina. They're not up quite as much as that, but a big move for them nonetheless this morning.
It sounds like some investors are looking for something other than AI, maybe, and they're looking for a little a new route.
Seems there might be a couple of them out there. The AI trade. You're right. We have seen a little bit of a rotation over the last week or two, well, several weeks, out of those AI plays and into the healthcare names. Specifically, the healthcare names have been some of the biggest beneficiaries. Now, they've been beneficiaries because they've been defensive, and investors have been looking to play a little bit of defense in this market. 20% move is
it's not defensive.
That's a little better than defense. That's right.
What do they say? The best defense is a good offense, right?
There you go. Yeah, that's right.
Okay, Bristol also rising on bearish stroke data.
This is an interesting one. So Bristol, they have had this drug that they've been trying to develop. I'm going to mispronounce it. Milvexian.
Sounds good to me.
They can yell at me later. Hasn't worked out quite the way they wanted to, but there's a competitor company, Bayer AG, which has now come out with some pretty promising results from a stroke prevention drug that they are developing. Cantor Fitzgerald sees this as being a positive development for the entire space. So for companies that are developing these stroke prevention drugs, this is a positive sign. And so you're seeing Bristol Myers Squibb move higher so far this morning. And largely, Wall Street is extremely positive on this. Even BMO Capital Markets, which had pointed out some of the struggles that this Milvexian drug had previously, thinks that there is a strong read-through here from Bayer and from their results. So could be just a case where, there looks to be a strong use case for a drug like this, and it's working well. And we are seeing that performance from Bristol Myers so far this morning.
Hopefully, not looking at it through rose-colored glasses.
That's right.
So hey, we're all health today. Anybody else showing some interest in other health units?
You know what?
In
the
health
healthcare
sector?
space is having it's having a big day. We talked about the AI trade. If you look past the healthcare names so far this morning, the next biggest move higher is Google. So it looks like there are still some buying in that AI trade. Google is up 5%, 5.2%. Maybe some investors that are trying to buy the dip. That's the other thing that we're watching today. Had such a sharp move lower last week. Will you see some names come back? That'll be an open question this week. As you said, it's a short one for U.S. investors with the U.S. Thanksgiving on Thursday.
All right, we'll leave it there. Jeff, thanks as always.
Thank you.
Jeff Morgan is Deputy Team Leader for the Bloomberg News Equities Team. Coming up, now that earnings season is almost over, where will investors look for direction as we head toward the end of the year? We'll get some ideas after this. Well, last week was all about earnings from NVIDIA and concerns over the AI trade, but now that earnings season is winding down, investors will have to look at other sources of data for direction. Let's get some ideas now from Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. Kyle, thanks as always for joining us.
Thank you.
Okay, so what are we looking for going into the new year?
Well, I do think NVIDIA's earnings last week did a bit to calm some of the concerns over the AI trade, but sentiment is shifting and volatility I think we can expect to continue. To the many AI investors out there, though, I would say that any long-term investment theme that you think is here to stay, it will have periods of good times and periods of bad times, disappointments, and I think you can either look at those opportunistically or you can look at them as a time to panic and buy into something else that you understand. Really, towards the end of the year, I think you mentioned it, there will be a bit more of a focus on some of that lingering U.S. economic data. Tuesday and Wednesday of this week, we'll see some reports that give a little bit more light into how the consumer is doing. But in terms of where I think that there are some things to be aware of and opportunity is, on something that's been well covered has been the level of concentration, particularly in the U.S. But I know we have some of the same issues just with different sectors here in Canada. Mm-hmm. But the U.S. healthcare has been something that your last guest talked about. Is something that I've actually talked on the show about quite a bit this year, and it finally seems like we're seeing signs of life there. I bring that up because there are entire cohorts of the market that are maybe less appreciated, still pretty reasonably valued, carry pretty good yields, and healthcare in the U.S. is something that we've certainly seen a lot of prospect in.
I was like, it's not really having a bad year, is it?
Well, not anymore. The last 2 months has been one of the best performing sectors in the U.S. Notably, actually, just last week, it was Eli Lilly became only the second ever non-tech name to reach a $1 trillion valuation. And they did that with some of the stories around obesity and the diabetes drugs that are out there and that they're capitalizing on. But yeah, over just the past 2 months, they're up 14%, but still the sector as a whole, I believe, is up about 11% year to date.
So is there still some deals to be had, do you feel?
I do, yeah. Particularly, I think if you're an income investor, I mean, you have Bristol Myers that's still trading at an over 5% yield and a single-digit price earnings. We own Pfizer, Johnson & Johnson, Bristol Myers again, Eli Lilly, United Health. I still think that there is room in that space, and some catch-up and some really just appreciation of the fact that the headlines earlier in the year around bringing U.S. drug prices down, some of the headlines from the U.S. administration weren't as negative as we maybe originally thought just a few months ago.
And I just want to go back for a second to the data coming up. How is it important, the data that we're going to see this week? Could it have a real swing on the market, real impact on the markets? And also thoughts on what we're going to see for a Fed rate cut. Will we see one? And same with up here.
Well, I think there's been all year there's been a big divergence between how investors are feeling about the world and how consumers are feeling. Particularly in the U.S., there's a University of Michigan consumer sentiment survey that I follow pretty closely. And they're actually reporting consumer sentiment worse than it was in the depths of 08-09, which is pretty shocking. I know that the stock market is a forward-looking beast, but I think we have to appreciate what the consumer is actually seeing. Higher income cohorts they've continued their spending at large, but some of the lower income segments, I think that's where a lot of people are taking their cues from some of the retailers like Walmart, Dollar General, Dollarama, which have had really great years. And I think that sort of speaks to some of the reason why, as people look away from maybe some of the brand name products that are out there. In terms of interest rates, I think I wouldn't be surprised. I do think it could go either way in December. And if it does go where they opt to hold things steady, I think they cite the lack of data availability from the U.S. government shutdown. But I do think we'll see at least one before the end of the first quarter.
All right. And I'm dancing a little bit, but getting back to the investing, what to look for. You feel one of the kind of the worst things you can do is just simply buy the index.
I do. I mean, I think there's a time where being a passive investor is okay, but I think we're in an environment today where if you're not being active, you're certainly could be jeopardizing your portfolio on the downside. I mean, if you are an index investor and that index falls 20%, your portfolio falls 20%, it's not a one-to-one. You need to rise 20% to get back to where you were. Just the way the math works out, you need to rise 25% just to get back to where you were prior to that correction. If you experience only half, if your portfolio goes half of what the index does, goes down 10%, you only need to get back 11% just to be back to where you were. That's just what the way the math ends up working. And I also think that there's a lot of opportunities out there on the international side that maybe go apart from some of the U.S. names and U.S. concentration. I think a lot of people today, even if you're buying a global equity fund because you want some more international exposure, well, most global equity funds have between a 50 to 60% weighting in U.S. names. I think you have to go more international, excluding North America. And there's a lot of reason to do so. I think particularly in Europe, one of the things that's driven the U.S. rally the previous years coming out of COVID has been a continued emphasis on fiscal spending. Everybody spent during COVID, but post-COVID, the U.S. really stood apart in terms of their spending to continue to prop up the economy. A lot of other nations didn't follow that and focus much more on bringing those deficits down. Europe is finally, and it's been evident this year, is there's been a notable shift towards spending. Germany is a very good example. I mean, with just their plans to increase on infrastructure spending, that's a doubling of what they're currently spending, and there's a lot of opportunity there for a lot of those names.
Okay, I just want to get to one more question because we want to get to some of your stock picks and staying European. NLS.pa.a, was that how you pronounce it?
Yeah, that's an Italian utility. I know being Canadian, we know our utility companies quite well. Goes back to the electrification around some of the data centers and actually some of the AI trade even. If you just look at the expected power needs of the data centers that are being planned in Europe over the next 10 years, that already is almost the equivalent of current power demand in all of Europe. So a company like Enel, it's trading at only about a 13 times earnings. That's in comparison to in the US and Canada, which are sort of in that low 20 price earnings range. They have a good prospect for continued steady growth. They have operations internationally, but I think European wise, they have quite a few catalysts for continued growth. And in the meantime, you're getting just over a 5% yield.
Okay, we're going to have to leave it at that. But Kyle, thanks as always for joining us.
Thank you.
Kyle Taylor is wealth advisor and portfolio manager at Tri-Delta Private Wealth. Friday on Market Call, we were joined by David Driscoll, founder and president, along with being the CEO of Liberty International Investment Management. His focus, global equities, and his top picks were Cameco, HDFC Bank, Lefco AB, and today on the show we have Paul Harris, partner and portfolio manager at Harris Douglas Asset Management. His focus, North American and global stocks. Up next, Canada's relationship with India is warming as Prime Minister Mark Carney and Indian Prime Minister Narendra Modi met face-to-face at a G20 bilateral meeting and agreed to renew trade negotiations. More on that next. Well, after trade talks broke down between Canada and India in 2023 over allegations that agents of the Indian government were involved in the assassination of a Canadian Sikh activist, Prime Minister Mark Carney and Prime Minister Narendra Modi of India met at a G20 bilateral meeting, and they've agreed to renew trade negotiations. Now, this is the latest sign of warming relations between the two countries. Let's bring in CTV's Colton Prale to talk more about this and how important is this? And good morning, Colton. And how important is this meeting?
Yeah, morning, Roger. This is incredibly important. I mean, I don't have to explain to your viewers, but you can group exports from Canada into two categories, to the U.S. and to everybody else. And in that second category, it's about 25% of our exports. Mark Carney has promised to double non-American exports. And getting into countries like India, like China, is going to be crucial to doing that. India is the fourth largest economy in the world, projected to be third by 2028, but they are only our 10th largest trading partner. We're talking about $5 billion in exports to them last year, $30 billion in total trade. I mean, that is a drop in the bucket compared to the $600 billion to the U.S. or even just the $30 billion exports to China. There is room for growth here, and creating the framework for those negotiations, ensuring that there's a dispute mechanism process, all of those things go towards improving trading relations with the country. We saw not only the bilateral meeting with Narendra Modi, not only the commitment to formally restart talks towards an economic partnership, but the agreement of a trilateral agreement, trilateral initiative, I should say, with India and Australia when it comes to tech and innovation. There is very much a concerted effort, not just on the goods side, but on the services side as well, to improve relations with India and to be more involved in that not only corner of the world, but in those economies. This is something where Canada has said they want to double total trade with India by 2030, up to $70 billion. And so this is very significant. We also saw the Prime Minister commit to a trip to India early next year. That's likely going to be the AI summit in February, but that part yet to be confirmed, although we know that he was responding to an invitation that Narendra Modi gave for that summit. And so, that this really is a move forward, but it's also important to keep the political context in mind, because as much as this is about economies and trade, there is a reason talks broke down, as you point out, in 2023. We know that transnational repression and foreign interference are two very significant concerns, and that India is a very heavy state actor when it comes to that involvement on Canadian soil. We know it's been an issue, and so the balancing act between those two priorities is going to be difficult, something that was put to the Prime Minister and the Public Safety Minister over the course of the weekend. Carney said that it's possible to have those economic deals with countries that you don't necessarily agree with entirely. He called it friction, and said you could gauge the level of interaction between the two countries by the depth of trade between the two countries. The Public Safety Minister pointed to an upcoming foreign agent registry as one way that the country would be trying to ensure that public safety was top of mind throughout all of this. It's important to point out, though, that foreign agent registry, has been long promised by this government, and they say it's still several weeks out before we see a commissioner and that agency actually created, and that's something that Canada has been very much a laggard on. And so this isn't going to go away. There will continue to be discussions about that balance, but certainly the Prime Minister has said that this is going to be something they're focused on.
All right, Colton, thank you for that update.
Anytime.
CTV's Colton Preo. Well, Couche-Tard will be a stock to watch later today when it reports results. So far this year, it is one of the worst performing stocks in the consumer staples sector on the TSX. We'll get a preview when we come back with John Ehrlichman. That's next. Alimentation Couche-Tard will report its latest results today after the close. It's down about 10% so far this year. And for more on this, we're joined by Ticker Take founder John Ehrlichman. John, thanks as always for joining us.
Good to see you, Roger. Yeah, this is a company that arguably could be described as one of the most successful Canadian businesses and one of the strongest performing stocks in Canada over the last 2 decades. I mean, in that period, it is easily a top 15 performer on the TSX. But as you mentioned, it's down this year, and it's down this year for a couple of reasons, Roger. One is that, generally speaking, stocks in this category, maybe you call it consumer staples or consumer discretionary, because obviously they're convenience stores, fuel up stations, etc. We've been talking a lot about AI and tech stocks. We've been talking a lot about gold and gold stocks, a little bit less so about businesses like this. And I think the other wrinkle for a Couche-Tard is that all eyes are on the consumer. And generally, the stories have been that the consumer isn't happy, right? They're not happy with what they're having to pay. And companies like this are on the front lines of this. Now, when it comes to the results, they will feed into what exactly the company is doing to appease consumers who are very frustrated by their bills right now. Because remember, this is a razor-thin margin business, whether it's gas or candy bars at the convenience store. A couple things they've been doing. They've really been trying to lean into their loyalty program, because if they can get people into that can help their profitability. And another thing they've generally been doing is trying to take over what the lunchtime crowd used to go to, other stores, having more ready-made food and things like that, because there's higher profit margins there. But it is a razor-thin margin business, so we'll see what they're saying about the health of the consumer right now.
And of course, everybody talking about as well, acquisitions, anything new on that?
Well, I mean, that has arguably been the biggest story surrounding this company for its past 20 years, in the sense that they have been so successful globally in making acquisitions to grow the business. And then most recently, of course, they went after what arguably was the largest player left, the parent company of 7-Eleven. We covered extensively how that just did not work out. And eventually they threw in the towel, couldn't get to the finish line, couldn't get the team there on board with their vision. But yes, I would be listening in to what the company says about M&A, Roger, because Wall Street and Bay Street are anticipating Couche-Tard's going to go right back into the M&A story at some point soon. Bloomberg was estimating they have upwards of $25 billion worth of funds to play with. Where would they go shopping? I mean, they've gone all over the world. So whether they did more deals in North America to build out, whether they did more in Europe, those are all possibilities. But the benefit for Couche-Tard in just continuing to acquire has been you refurbish, you get everybody into your fold, and the cash flow that comes in from these convenience stores and these fuel up stations is incredible. And that's one of the reasons they've been a target by investors, a dividend play, all that kind of stuff. So we'll watch to see what they have to say on that front too.
And what about on the domestic front? What numbers will we be looking for? I mean, they've got the beer sales in Ontario. That's an important one. What else are they looking for domestically?
Exactly. Yeah. On average, Bay Street and Wall Street think the company will see a lift in their sales. And so that could potentially include a little bit of lift in the Canadian market. But I do think this story of the consumer uncertainty likely will still be hanging in there, if you will.
Yep.
So it's something to watch as well.
All right, John, thank you as always for joining us.
Thanks, Roger.
And that's Ticker Take founder John Ehrlichman. Coming up, Morningstar's predictions for markets in 2026. Stay with us. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Industry Minister Melanie Joly is heading to South Korea today to meet with major Asian companies to try and attract large investments into Canada's defense sectors. The meetings will include talks with one of two bidders on Canada's major procurement project. Joly is also meeting with a Korean business conglomerate and then heading to Tokyo. Her talks will cover the automotive industry, battery manufacturing, shipbuilding, and mining. Canadian factory sales fell about a little more than 1% in October, marking a partial reversal after a rise of more than 3% in September. The largest decreases in October in the chemical and forest products sectors. Manufacturing shipments are also down 1%, reflecting pressure factory owners face due to uncertainty in trade with the U.S. The data is early estimates by StatsCan and may later be revised. Ontario has designated energy provider Hydro One to develop a new transmission line in partnership with First Nations communities. First Nations will have an opportunity to invest 50% equity in the line through the First Nation 50-50 equity partnership model. Ontario's Minister of Energy and Mines advised the Ontario Energy Board to develop a new transmission line between Bowmanville and the Greater Toronto Area. And taking a look at the markets, they are bouncing back again today. The TSX up again for a second day, 0.5%. South of the border, optimism there as well. It's a good day so far. It's early, but it's a good day so far. S&P 500 up by 0.9, almost 1%. Dow Jones up by 0.22, and the Nasdaq bouncing back 1.75% right now. And looking at oil, it's still struggling. It's off again slightly and well down below that $60 mark that it had been hovering around for a while. It's down at right around 58 for WTI. Whereas gold, well, it's on the way up a little bit, albeit slightly. Everybody trying to see what happens with the Fed rate cut, if it's going to happen or not. Right now, gold's sitting at a little over 4,100, 4,120. And the loonie, still facing downward pressure on some economic numbers. It is off slightly right now at 0.01%. No one can predict what 2026 will bring, but there are some themes that have emerged on a consistent basis in 2025, such as tariff tensions and high valuations in the AI sector, making investors nervous. Morningstar has prepared a report with an outlook for 2026. Let's bring in one of the authors, Philip Strahl. He's Chief Investment Officer covering the Americas for Morningstar Investment Management. And Philip, thanks very much for joining us.
Thanks for having me, Roger. It's great to be with you.
Let's start off with the trade tensions. What kind of a factor do you see that being in 2026?
Yeah, I think it's settled in terms of some of the frameworks that have been put in place. But I think one of the things that is still an uncertainty at this point is the potential decision by the Supreme Court in the United States, potentially in December or January, with an announcement around their decision as to whether some parts of the tariff framework, whether that will be shut down. I think that will create some volatility. So as we look into 2026, we don't expect the April level, volatility, but certainly still uncertainty around there with the tariffs in 2026.
What kind of a twist would a ruling have that some of those tariffs were unenforceable? They'd have to pay money back. That could make for a bit of a nightmare for businesses.
Yeah, I would say actually the biggest trading partners, our expectation would be that those tariffs will just be shifted in terms of the legal statute. So there's probably not a huge impact. Some of the smaller trading partners, it might actually be a relief, but it will just create uncertainty in the market where markets will be wondering which sectors might be impacted. But by and large, we would not expect the same type of downside risk as we've seen in April of 2025.
And geopolitically, I mean, we're hearing possible talk of a peace deal between Russia and Ukraine. No guarantees, of course, with everything the way it's unfolded there. But I mean, there is talk of that. What kind of an impact would something like that? Are there any other geopolitical aspects that you're keeping an eye on?
Yeah, the Ukraine-Russia deal obviously would be significant in terms of the impact from a humanitarian standpoint. We'd say energy prices, oil markets would likely be most impacted by that. We've seen some downward pressure on oil, as you've pointed out this morning. And so it's mainly on the energy side, we would think, as far as, kind of the market implications, but obviously a very important deal as well. The second element will be defense companies, which have done very well this year, especially in Europe. And so a potential deal there would put potential downside pressure on defense stocks if that were to come to fruition.
And of course, the thing that everybody's talking about, AI, what's next for it? We had some pretty good earnings for the most part, still some nervous investors out there. Is that going to change, do you think?
AI has been the dominant theme for the past 2.5 years, really off of the low in April. That really was what reassured markets, and a lot of these AI stocks, NVIDIA, did very well off that low in April. But we think that there's probably been a level of frothiness and very elevated expectations that have been baked into some of those valuations, and we've seen a bit of a pullback in these stocks in recent weeks on the back of even beating earnings. And so at this point, it's probably more of a sentiment shift. But going into 2026, big question is whether those companies will stick to the CapEx plans that they've announced so far this year.
And they've been aggressive with that. Is that what's making most investors nervous then?
I think it's part of it. I think there's a technical element, as I mentioned, where I think the market's gotten somewhat narrow, especially in the September-October period. And in recent weeks, we've seen a bit of an unwind there. But if we were to see a pullback on the CapEx guidance by the large hyperscalers, I think that could lead to more significant downside. So our view would be for investors to try to diversify away from some of those large cap names and find opportunities perhaps in higher quality healthcare and consumer businesses, for example.
And yeah, healthcare's it's had a nice bounce back lately, and you still think there's some deals to be had, though?
We think so. Yeah, we think it's underperformed the S&P 500 for the third consecutive calendar year. It's kind of lagged the S&P by about 70% over that time frame, and so we still think that there's value. It's has better earnings growth than the overall market, and we still think that there's room for some of that regulatory overhang to ultimately boost some of those stocks.
And outside North America, what are some of the things you're looking at?
We still like non-U.S. stocks from our perspective, especially if you are, from a Canadian or from a U.S. investor standpoint, given valuations, also from a currency perspective. We like Latin America as one of the areas. For example, in emerging markets, it's trading at Brazil, for example, is trading at 11 times earnings, and that's much more attractive than, let's say, the S&P 500 that's closer to 23 times earnings.
And also, you mentioned in some of your notes here, talk about the UK as well is an interest to you.
Yeah, the UK is, despite its, kind of economy that is, there's obviously different things going on with the budget there, but access to a lot of high-quality global businesses. And if you look at that market from a valuation standpoint, we can still see a lot of value in those businesses. And so, given the strong rally we've seen in many parts of equity markets, we think the UK is an attractive area to be as well.
And just one, we're almost out of time, but just quickly about South Africa as well. You're calling it a hidden gem.
Yeah, South Africa is one of the markets that we like, and we think from a commodity cycle standpoint, and given some of the pressures we've seen on the commodity side of things, that's an area that we like. It's an early story, and we might see some volatility there, especially if we talked about the geopolitical dimension, but it is one of the areas that we like as well within emerging markets.
Okay, we're going to leave it there, but Philip, thanks very much for joining us.
Thank you, Roger.
Philip Strail is Chief Investment Officer covering the Americas for Morningstar Investment Management. Coming up, more on BHP walking away from Anglo American for the second time after its latest approach failed. Well, BHP has ended its attempt to acquire Anglo American, stating it is no longer considering a combination of the two companies and will focus on its own portfolio. For more on this, we take you to London, where we are joined by Bloomberg's executive editor for the Global Deals team, Aaron Kirchfeld. Aaron, thanks very much for joining us.
Good to be here.
So I guess the question is, why did BHP back down?
Well, I think when we broke the news that BHP had made this approach to Anglo, we very quickly learned from sources that Anglo had rejected the proposal, deeming the deal that it had previously agreed to with Tech Resources as a superior transaction. So BHP made the surprisingly quick decision to walk away because they were not receiving a warm welcome from the Anglo side, according to our sources.
And did they give any details for the tech deal, that what they like about it?
So I think, when Anglo announced the tech deal, they were very vocal about the fact that this creates a copper giant. Copper is kind of the key word in mining right now. It's at the heart of electrification. So when Tech announced the merger with Anglo, they really pitched the merits of the deal, creating, something like a $60 billion copper giant based in Canada. And so I think Anglo, sources just viewed that transaction much more desirable, combining with another kind of equally sized or slightly smaller player than being gobbled up by the world's biggest miner, BHP.
I mean, and it was a pretty good deal, but I guess they just didn't like the numbers with it.
Yeah, the interesting thing about this deal is it's somewhat shrouded in mystery. So when we broke it, it wasn't public. No one knew these talks were happening, this approach had happened. And we still don't know what exact price BHP offered. So it's hard to say what was rejected, which is unusual in these type of situations. But I think the fact that BHP walked away so quickly, that gives Anglo a bit of leeway not to disclose those figures. So there's different numbers going through, the rumor mill, but the reality is we don't know exactly what they offered. But whatever it was not enough to get Anglo to the table, and it was enough, the negative feedback was enough to, convince BHP executives to walk away from what would have otherwise been a huge and transformational deal in the mining arena.
And I know there's no such thing as forever, but does it feel like this is forever they've walked away, or are they going to maybe come back once we've seen, if assuming this goes through the deal with Anglo and Teck, that we see a consolidation there, and they come back in a year and look at it?
I think theoretically anything's possible in mining. I think the fact is, though, if you look at last year, BHP tried to do this deal for Anglo, and it was several weeks of drawn-out feud that they walked away with. This time they tried again, and I think for various reasons. There's some Canadian pushback on the Anglo Tech headquarters and deals. The stock of Anglo have come down a little bit, and the shareholder vote for the Teck Anglo deal is coming up. So some people they theorize that BHP saw this as kind of their last opportunity to get into that deal, to maybe thwart the merger before that gets completed. Could they look at it down the road? Possibly. There would obviously be some regulatory and antitrust questions, and it would be more expensive. But if there's one thing we've learned over the years is that in mining, there is no lack of big and bold moves. They don't always work out, but they do at least try.
And it does feel like there's a bit of a trend towards consolidation in mining.
Absolutely. The reality is that all the big miners are speaking to everyone, and it's always about who has the courage, the guts to pull the trigger. Even if the Anglo-Teck deal goes through, that doesn't reduce the pressure of the others to consolidate. So the likes of BHP, Rio are all looking over their shoulders. Are there any other copper assets out there? Any other consolidating partners? So what I can definitely promise is we will see more mega mergers going forward. This is not the end of that story.
Okay, we'll leave it there. Thank you very much, Aaron, for joining us. That's Bloomberg's executive editor for the Global Deals team, Aaron Kirchfeld. Coming up, we'll have a look at some of today's notable calls with a focus on European automakers. Okay, let's take a look at some of the notable analyst calls and recommendations. Today, it's European automakers. Ferrari, BMW, and Mercedes-Benz all initiated with buy recommendations at Goldman Sachs, while giving neutral ratings to Volkswagen, Stellantis, Renault, Porsche, and Aston Martin. Goldman Sachs says these are tumultuous times for European auto OEMs. Analysts led by Kristen Friends says Mercedes and BMW offer healthy balance sheets, cash flows, and shareholder-friendly capital allocation frameworks, and tailwinds from compelling product lineups, as well as relative ability to position themselves against Chinese competition. And so, taking a look now, a couple of the charts here. You see BMW, what it's done so far this year, over the last year actually, and it is up. It's been improving, and Mercedes was just up before that. Now, Ferrari is getting a buy recommendation. Of course, we've heard about Ferrari wanting to stay elite. They're not going to chase any other markets, and that's apparently paying off for them now. It's a buy recommendation, and Goldman Sachs says it expects larger volumes of higher-priced special series vehicles to pave the way for beats versus current consensus estimates. And you can see, though, Ferrari off right now over the last couple of months, but a lot of people expecting that to go back up. Now, Volkswagen and Stellantis getting neutral ratings as these mass-market vehicle makers are expected to face more challenging headwinds than their premium peers. And Volkswagen it's up from a year ago, but not from its peaks in February and March, still trying to recover there. And Stellantis, taking a look at what it has done for the past year. It has slumped since April and is yet to recover. Of course, everybody took that hit in April, but it has not bounced back from there. And Porsche getting a neutral. Analysts expect further upgrades to current consensus EPS estimates to be constrained by near-term tariff headwinds, restructuring costs, and absence of meaningful recovery in China. And you can see Porsche still slumping from April as well, trading well below its peak at the start of the year. Coming up, Citi's report on the impact of AI on the finance industry. Stay with us. Prime Minister Mark Carney says the world can move on from the U.S. after its boycott of the G20 summit held in South Africa. Carney says the summit brought together 2/3 of global GDP and that the center of gravity in the global economy is shifting. U.S. President Donald Trump boycotted the summit, saying white farmers in South Africa are facing a genocide. Canada and India have agreed to resume bilateral trade talks. The announcement coming this weekend after a meeting between the Prime Minister and the Indian Prime Minister, Narendra Modi, who was on the sidelines of the G20 summit. The leaders aim to reach $50 billion U.S. in bilateral trade by 2030. The two countries exchanged about $31 billion in goods and services last year. Shares of Alibaba are gaining today after the company said its revamped AI tool hit 10 million downloads in its first week of being open to the public. The company made the announcement in a post on the communication app WeChat. The app is set to incorporate functions that include e-commerce, and it's expected to rival ChatGPT. Looking at the markets, you can see south of the border, they are recovering again today after last week's volatility. S&P 500 up 0.86%, Dow Jones 0.24%, and the NASDAQ is up almost 1.6% right now. TSX having a second good day at this point. It's up 0.62%. And when we look at oil, it's reacting. It's off again, well below 60. It had been trading above 60 for a little bit, but it's back below that. It's below 58 right now. And that's probably on the likelihood of the possible end of the Russian-Ukraine war. It's being assessed right now if it will happen and what kind of an impact it would have on oil. Gold, meanwhile, steady as she goes, up about $8 as it weighs the chance of another Fed rate cut. It's at 41.24 right now. The Canadian dollar, little changed off slightly, 0.08% relative to the greenback. Sentiment remains soft on trade headwinds and a lack of broader appeal for investors. And Bitcoin. It has been on a roller coaster ride. It is down again, 2.28%. Crypto has had a bruising week. Bitcoin, I think, is off by more than 10% in the last week alone. Citi is out with a report on how agentic AI could impact the finance industry. And according to the report, AI and agentic AI could have a bigger impact on the economy and finance than the internet era. That's saying a lot. Let's get more on this from one of the authors of the report, Sophia Bantanides, Future of Finance Analyst at Citi. Sophia, thank you very much for joining us.
Thank you so much for inviting me to cover our report.
Let's talk a little bit about what exactly agentic is. Everybody's just getting used to saying AI, and now we're adding agentic to it. What is it, and how will it change AI?
Yeah, that's a very good question. The quick answer, and I have 3 words for you. Agentic AI is generative AI plus action. Agentic AI is the do-it-for-me technology. It sets a goal, it plans a task, it takes action, and it adapts to feedback. This is very interesting in the financial services space. Let me give you an example in the payments area. It can take steps to resolve a problem or an issue with a payment where there has been a payment error. An agent can go through an autonomous workflow. It can go through your unstructured data, cross-check things, confirm where the mistake has been made, amend the payment mistake, submit it for approval, and log it in the audit trail. That's agentic AI. It builds on generative AI. And because we have generative AI, we are able to have agentic AI. Generative AI is the create-it-for-me technology. Agentic being the do-it-for-me technology. Of course, AI as a branch, as the umbrella term, we have had for years in financial services. We've had machine learning AI, traditional AI, since I believe it is 1956. That type of technology works very well on structured data. But most data we have in financial services is unstructured. And that's why generative AI and its sister or cousin, Gen AI plus Action, agentic AI, is very interesting for financial services. And that's why we wrote a big report about it. Agentic AI, finance, and the do-it-for-me economy, publicly available.
Now, you had a quote from Ren Ito, the co-founder and CEO of Sakana AI, and said this year, 2025, will be a wow year for agentic AI in finance, similar to the year 2023 for being a wow year for Gen AI and 2024 for large language models. Has it been then, in your eyes? Has it been a wow year, 2025?
Yeah. Look, I think it has been a wow year. We say in our report, we quote Ren Ito, like you said, we quote many others. We say 2025 is the year of agentic AI. I think so, because it is the moment where different pieces of the puzzle came together. Number one, the models, the LLMs. Number two, the cloud infrastructure. We've seen the big hyperscalers. I'm not going to name any names. We all know who they are, but they have gone all in on agents, right? They have shipped the tools for us to use. So we got the models, we got the cloud infrastructure, and we have the enterprise controls and guardrails. We are starting to move past demos and prototypes and into some use cases. Yes, we're only still scratching the surface, but we are starting to move in that direction. And when I look back on the year for myself personally, I speak at conferences, financial services, FinTech Future of Money conferences around the world, from Mobile World Congress to more recently Money 2020 in Vegas. When you look at the agenda and where the conversation is, everyone is talking about agentic AI and doing something with it. There has been an awful lot of money as well that's been poured into this space. We talk about that in our report. We're starting to see these shifts from pilots to production, and that is why I think 2025 was the year of agentic AI, and next year will be even more exciting.
And so how do you see it being implemented for 2026 and then beyond that? And what kind of an impact does this have, on careers, on people who work in the industry? Are we going to see mass layoffs, do you think?
Yes, okay. That's an awful lot of questions.
That's a lot of questions. Sorry, I'll stop now.
Right, let me take it in turns. I think the first question you said is what I think will happen as we look at the year ahead, right?
Yes.
I think 2026, we will see more deployment, okay? Potentially the year of scale deployment, something like that. So that's one thing. I think what we will also see is measurable commercial impact. By that, what I mean is we're going to start to hear about the first return on investment stories. That's my personal view. Because as we know, we have a shift with AI from, wow, this technology is so cool, to how are we implementing it, to ROI, right? Return on investment. And there's a time lag for all of these things, okay? The next thing that I think we will see is the conversation will shift towards agentic commerce. What I mean by that is when agents start transacting on your behalf, they will show you options, but they can also act for you in financial services. They can compare financial services products. They can potentially move your funds around to find the best savings product or to renew your mortgage. This idea of agentic commerce, which will be a real game changer when a bank's clients like you or me start using AI on our banks. So that's what I think is going to happen next year in terms of sort of agentic AI and where the conversation is going. Then I think you also asked me about the jobs question, right?
Yes.
Are we all going to lose our jobs? And, this is what I love and hate about AI is it creates such polarizing views and discussions, particularly around the jobs point. It is a point we have addressed in our report. The short answer is yes, tasks are going to change. The tasks we do as part of our jobs are going to change because of this technology. The implication of this technology and generative AI is that productivity is going to rise. We're all going to be more productive. And therefore, we will shift towards higher value activities and higher value tasks, be that tasks that require oversight, tasks that require judgment, tasks that require a certain type of client engagement or handling exceptions in financial services or strategic work. What we also say is that some repetitive operational roles, some that you would traditionally outsource, those may shrink over time. Yes, that is also true. But new categories of work and new jobs will emerge, things that we perhaps hadn't imagined in the past. Examples of these new types of jobs are those who will supervise the agents, your agentic AI ethics officer, your agentic AI guardrails officer. Now, they might be called something else. The person who designs the workflows, the one who manages data quality, the person who enforces governance. All of these are examples. So agentic AI doesn't replace the workforce, it reshapes it. And that's why I think it's important that we are all curious, that we adopt to technology. It will not just change the way we work, but also the way we live and the way we enjoy our lives, the way we play as well.
And moving on to with using agentic AI, I mean, there's a concern with ChatGPT, things like that, that you have to be careful about what kind of answers you get because it's of the sources. How will we know anything involving agentic AI is accurate? How do we learn to trust it?
How do you learn to trust it? Okay, here you are talking about the hallucinations that we are seeing with generative AI. I think you have to put in place very similar guardrails and governance frameworks, such as the ones that firms have been putting in place with generative AI already. And we are already seeing in some parts of the world take certain approaches to regulating the application of AI. Look at what Europe is doing and the framework it is putting in place, and look at what's coming out of the other standard-setting bodies. They already give you very good ideas in terms of what kind of questions you can expect from regulators and policymakers when they come to scrutinize your AI frameworks.
And with the agentic AI, I imagine money. People are going to be interested in this, venture capital funding. What are we looking at? How much is going to be poured into AI right now over the next little while?
How much will be poured into AI into the future is not a figure I have for you, Roger. That's not something we put in our report. We have looked back and said how much money has already gone in, and an awful lot of money has already been poured in. My personal view, and from what I've seen, is I don't think that amount is necessarily going to decrease given the momentum and where we are in the market. We've also seen the number of deals grow an awful lot. We covered this in our report, but again, that's looking backwards. And the top deals, the ones that have seen an 150% increase, it's looking back, right, from 2023 to 2024, are those involving autonomous agents, digital co-workers, and generative AI for chats.
All right, and I think one last question. I saw this stat that you had in there. 50% bots account for 50% of the global internet traffic. A large part of them are malicious. Is this going to help, or is it going to make that situation worse, do you think, with agentic AI?
It's a bit of both. I thought you might ask me about that figure. It is one that has made an awful lot of headlines. Yes, let me give you a little bit of context. What we say in the report is that agentic AI, yes, it is also a delivery mechanism that can enable the dissemination of fraud at scale. And, 50%, like you said, or fraud already involves some kind of AI. And what we also say in our report is that it is likely to increase. The reason for this is illicit actors can adopt technology at speed. They don't have to adhere to any rules and regulations like we do. And they're also very, very good at data sharing. So there are a couple of things that we call out in the report that we can do to enable agents to act with sufficient authority without compromising security. Maybe I'll just pick on two of those. One is having AI wallets. When you think again about commerce and payments, having a pre-funded wallet for your AI agent so it can transact, but its budget is capped. It can only transact up to a certain amount. Then the second piece is having an automated authentication layer. You need to think about how you are going to authenticate these agents. For example, asking your agents for contextual authentication, looking at the chat history of the agent, rolling all the way back up to the original ask that the human made, and tracing that and tracking that. Those are just two examples of what can be done. And overarching all of this, of course, is the robust governance framework that firms need to put in place, define permissions, human-in-the-loop controls, and secure enterprise infrastructure.
Okay, I know there's tons more we could talk about this, and I'm sure we'll be talking again in the future. Sophia, thank you very much for joining us.
Thank you so much for having me, Roger.
Sophia Bentonidis is Future of Finance Analyst at Citi. Coming up, Hot Picks. We'll zero in on 3 plays in industrial stocks that benefited from the AI build-out right after this. Time now for Hot Picks in industrial stocks. Our next guest believes his picks will benefit from the AI build-out as they are building critical AI infrastructure, but there are signs of an AI bubble and how that might impact his recommendations. Joining us now is Martin Toner, Director of Institutional Research, Growth and Innovation, ATB Capital Markets. Martin, thanks very much for joining us.
Thanks for having me, Roger.
Let's get right into it. First up, any concerns with what we're just going to talk a little bit before we get to those 3 picks? Any concerns with that AI bubble that everybody is possibly talking about?
Always tons of concerns, and all great growth stocks climb a perpetual wall of worry. It's no different in this space. I mean, the AI space has materially outperformed this year, outpacing most of my coverage universe, including some of the SaaS stocks I cover, as growth investors have been finding better growth in AI than other spaces. Now, that trade's come in a lot. NVIDIA's down about 15%. The Bitcoin miner ETF is down around 40%. Now, that ETF has become a high beta AI play because those companies are currently becoming data center providers for AI. I mean, the bears have become pretty loud, and they question the GPU rental rates, the useful life of a GPU, the circular financing, if and how and who will finance the significant capex required, and how can the industry possibly get an adequate return on the massive $5 trillion investment in capex that we expect to go in. The ATB view is that currently, amongst hyperscalers and neoclouds, most GPUs, even old ones, are currently sold out. An older GPU, say a H100 that's 2 or 3 years old, might rent at a lower rate than some of the bleeding edge GPUs, but regardless, they're still sold out.
Okay.
In fact, some AI is currently being done on CPUs. So back when Microsoft reported, the CEO said that if they were not capacity constrained, they would have grown faster. So to me, that implies that the returns they're getting on their existing investments on AI are pretty high. I mean, the question is, can that persist? And we think it can.
Okay,
and we think these Go ahead.
Oh, sorry. I want to jump in because I want to get into the stocks you want to talk about. We're getting tight for time. So TeraWulf, it's long-term data center contracts that are attractive to you?
Yeah, so they're an infrastructure provider that's currently building out more than 1 gigawatt of capacity. They currently have 3 contracts with 2 customers and a very large guarantee of those contracts from Google. When I look at what this company is going to be in a couple of years, based on them delivering on time, they'll have about $1 billion of EBITDA in 2027. And the stock's currently trading at, if you include all of their debt, 7 or 8 times that amount. If you look at traditional data center providers, they trade at up to 3x that amount. So we think with continued execution and more growth, this stock represents a pretty interesting opportunity.
Okay, and I want to get the other 2 in as well. Bitfarm, it's down 60%
Absolutely.
from October.
Yeah. I mean, you look at the stock, it looks a little crazy. One thing to keep in mind, so they're sort of a fast follower in this space. They're a year or a year and a half behind TeraWulf, but since the lows earlier this year, they've significantly de-risked the balance sheet. They now have roughly $1 billion in liquidity. Stock has an market cap of about $1.5 billion. And they have a lot of capacity, more than 1.5 gigawatts. So as they build out this infrastructure, stock currently trades at an EV of less than $1 million a megawatt. And based on our analysis of existing deals, the opportunity of a deal is to increase value to up to $8 million a megawatt. So there's plenty of opportunity in this stock, and it's sort of the highest beta of all of these names. So if you're a believer in this space, that's an interesting one to take a look at.
Okay, and the last one, we got about a minute or so. Galaxy Digital.
Yeah, Galaxy Digital, a company we've covered for a while and really like. They're sort of 2 companies in one. One is an AI infrastructure player, a little bit like TeraWulf. They have contracts for 800 megawatts of capacity that they're building out over the next couple of years, and they have potential to grow that significantly. And then the other side of the house is a broker for institutions that are trading and investing in digital assets like Ethereum, Bitcoin, Solana, and other cryptocurrencies. Now, the stock is priced for, we think both of these businesses are worth about $30 a share. Mm-hmm. Stock's currently $20 a share US. So we think there's a lot of opportunity here. I'm not too sure what investors are paying for in the current stock price, given that these 2 trades are they've been fairly correlated. Like if you take a look at price of Bitcoin and compare it to some of the AI stocks, it's fairly correlated. So both things have been moving in the same direction. But we think that this dip is a nice opportunity to buy a high-quality company with a great growth story.
Okay, we're gonna wrap it up there. Martin, thanks for joining us.
Thanks.
Martin Toner is the Director of Institutional Research, Growth and Innovation at ATB Capital Markets. Coming up, graphic designer platform Canvas is one stock investors have been eyeing to go public. We'll hear from COO and get a timeline on a potential IPO. That's next. Canva co-founder and COO Cliff Obrecht joined Carolyn Hod on Bloomberg Tech to discuss the digital graphic design company's product rollouts and how it's been building out its leadership as it prepares to go public in the near future. Take a listen.
We've been absolutely blown away by the level of uptake. It probably really speaks to the creative community screaming out for choice and us delivering on it. But yeah, we've been absolutely blown away with the pickup so far.
Affinity is about professional design in many ways. But how are you seeing being adopted more broadly, and who is it that really wants to lean into this type of sophistication?
So Canva is a design tool, and when we launched Canva, there were only professional design tools. So we launched Canva to enable the 90 to 99% of the world who couldn't design to be able to design and express their creativity. And what we did with the acquisition of Affinity, we acquired that company and we just launched it 100% for free. And that really gives creative freedom and the ability to create and design to the other 1 to 10% of the organisation. So now we have both professional designers and everyone else able to design for free and with ease, and not let the tools or cost get in the way of people achieving their goals through visual communication.
Look, I'm looking at some analysis that was put out. One analyst is calling it from a visual suite to a comprehensive creative operating system. They say that it launches Canva into beyond the tool for simple graphics and to challenge Adobe's long-standing market dominance. Is that what you're doing? You're challenging Adobe here?
I think we really just think about how do we help organisations achieve their visual communication goals? How do we... People don't wake up in the morning wanting to create a social media graphic or wanting to create a presentation. They wake up wanting to achieve a goal, whether that's a small business trying to raise money, whether that's a large organisation trying to win more customers or deploy great marketing content to grow their business and revenue. We're really in the business of helping businesses achieve their goals, and that's quite a complex process in a large organisation to create on-brand content at scale. And we really have connected all of that complexity through the creative operating system and help businesses deliver on that promise.
The promise is being borne out with the statistics and the money that rolls in, $3.5 billion in terms of annual revenue, users 260 million, you've been profitable for 8 years. All of this seems to hint that you're on the path to becoming a public company. Is that right, Cliff?
Yeah, it's probably imminent in the next couple of years, that's for sure.
Imminent, and what, therefore, do you need to streamline before that? How much are you thinking about your talent? I know you've done a raise where you're able to offer liquidity to those that have been working with you, but how are you able to get the right talent in the door and retain them at this moment?
I mean, Canva is one of the fastest growing companies in the world right now, and so that helps. It's a great product solving real problems for customers and delivering lots and lots of value. So people are excited to work at a company that really helping, like that company that is helping their customers achieve their goals and is delivering on that success and is growing fast. And we've hired an incredible leadership team over the last, since the start of Canva, and a lot of our leaders have been with us for 8+ years, but we have also brought in a really great C-suite of folks like our CFO Kelly, who came from Zoom, and a bunch of others to really sort of like pad out that leadership muscle in the lead up to an IPO and beyond.
You are really augmented by AI in many ways, but some would say that OpenAI is a key competitor of yours. How do you see that with Sora? How do you see innovation as your lifeblood?
OpenAI are an absolutely fantastic partner of ours, and you can even start a design within ChatGPT now. So if you're creating a presentation outline, you can simply say, can I please have that as a Canva design? And it will give you that Canva design straight into ChatGPT. And then you can click through to Canva for the final mile of editing, collaboration, deployment, and then understanding how that content actually performs in the wild. So we have an absolutely fantastic partnership with OpenAI, and we really build the tools around the models like Sora. So in order to create a video, there's a lot more than just prompt to short clip. You need to create character consistency, audio. There's so much more. So we really create that end-to-end workflow that enables video creation, design creation, and now we're the first company in the world that's launched a layered design model. That really generates a Canva design that you can edit straight away, rather than having to, every time you make a change, redesign or recreate that image or piece of content.
That was Canva co-founder and CEO Cliff Obrecht. It's time to check out the markets before we go to a break, and you can see everybody having a good day right now, all above 1%. On the green side, TSX is up 1.03%. It's being pushed by Celestica. It's up 9.21%. Aris Mining, 7.86% right now. Fortuna up by 6.99%. And looking south of the border, you can see the S&P 500 up by 1.19%. And the NASDAQ as well is up by nearly 2%. And that's being driven by tech stocks. Again, Broadcom up 8.72%. Micron Technology, 6.65%. Tesla, 6.4%. Alphabet, 5.8%. All seeing all kinds of moving in the tech stocks. Again, not all that surprising. Well, that wraps up this edition of The Open. Morning markets are coming up next.